Welcome to the Osborn Financial Group podcast, hosted by Jarrett Osborn. Join us for expert insights on wealth management strategies, essential tips for securing your financial future, and in-depth discussions on life and health insurance options. Get practical advice for protecting your assets and loved ones, proven strategies for maximizing investments, and real-life examples to illustrate key concepts. Stay tuned for Q&A sessions with industry professionals and actionable steps to take control of your finances and insurance needs. Tune in now and empower your financial journey.
Hello, everyone, and welcome back to another episode of the Osborn Financial Group podcast. I'm your co-host, Jeremy Wolf, joined by your host, Jarrett Osborn. Jared, always a pleasure, brother. How you been?
Thank you, Jeremy. Appreciate it.
Yeah. And thanks, as always, to our listeners for tuning in. So, Jarrett, you recently wrote a wonderful article in Cooper City Living Magazine, and you touched upon some basic concepts on understanding life insurance needs. So I thought that now would be a good time to maybe do some like FAQs, frequently asked questions about life insurance, to talk a little bit about the various aspects of what people can expect with life insurance and what it all is. So to set the stage, why don't you start off by talking a little bit about what is life insurance and why is it so important for people?
Right. Life insurance, as its name says, is basically insuring yourself in the event that, you or the insured passes away. That's the main reason for life insurance: protect your loved ones, protect beneficiaries in the case of unfortunate demise. There are other applications for life insurance, for estate planning. There are investment applications for life insurance, using it as a build up for cash value. But to keep this short and sweet, I can go get a lot into it. That's the main reason that people get life insurance, to protect loved ones in the case of a unfortunate death down the road. So that's the main purpose of life insurance.
Yeah, and I think too many people wait too long to explore this, because in their mind they're thinking like, oh, I'm young, I could do it later. But this really plays a bigger picture, or plays a part in the bigger picture of what you do through financial planning and life insurance, and really coming up with a policy that kind of checks all the boxes for somebody, and really starting that process as early as possible, even if you're not investing a lot into that, just get in the habit of doing it, so that as you progress through life and you build more wealth and assets, everything's protected, right?
Correct. Ideally, you start getting life insurance. The younger, the better, obviously, because the main component of your life insurance is your health. Okay, so the healthier you are, the better rating you're going to get, the cheaper the cost of insurance. Hence, the younger you are, typically the lower the cost, depending on your health, obviously, the lower the cost. And obviously, typically, the younger you are typically healthier when you're younger. So the longer you wait for this, the longer you wait to apply and get life insurance, typically the more costly it becomes. And I don't mean when you're 16 years old. Obviously, the main reason you get life insurance, again, this is just the easy explanation, but the main reason for life insurance is to protect your family. You don't typically need life insurance when you're 18, 19, 20, unless you're married and you don't necessarily have to have children at that point. But typically you start the life insurance process, or at least thinking about it, when you get married, when you start a family, and hopefully that's done, or typically that's done for most people at a younger age. Like I said, there are other applications for life insurance for investment purposes. We'll get a little bit into that. The main reason for life insurance is to protect your loved ones, and that's typically done when you're young, when you're starting a family. So yes, the younger you are, the healthier you are, the less costly the life insurance is. And we'll get into the different types of life insurance, and we'll discuss that as well.
How does one determine, or how do you determine when you're working with a client, the level of life insurance that they would need?
Right. So it's pretty subjective. Okay. I'm a big believer in try to get as much as not as much as you can, but even get a little bit more insurance than you probably should get based on what I'm about to tell you when you're younger, because there's a couple conventional, if you read a book, it says get 8 to 12 times, 8 to 15 times, 10 to 15 times your income. So if you're making $100,000, $1 million would be a place to start. And believe it or not, $1 million when you're young and healthy is not that costly to get. $1 million is not what it used to be. That was always a good starting point. So I always say, look, if it's in your budget, let's quote $1 million, but let's look at 2, because look, you're 20, 21, 22, 23, 24-year-old, you're starting a family. Your career is typically in its early stages, especially if you're in a occupation that you think will grow, that you're going to make a lot more money down the road. I always tell people, look, you can start with $1 million, but if you get 2 million now, or maybe even more, you're getting it. 1, it's much cheaper to get now because you're younger, probably healthier. And 2, you take that anticipation or that future potential that you're going to be making more down, because most people have 2, 3, or 4 policies. Most of my clients start off, they got the policy when they were young, and, we're talking people who are 20, 30 years down the road. Then they start making more money in 5, 10 years, and they get another policy. Then, a lot of people start making a lot more money, and they're like, you know what, I need more. It would always say, let's start with and again, you can start with the $500,000, and a lot of people have it through work. And there's another issue with that type of insurance, but conventional wisdom, you read a book, it says get 8, 12 to 15 times your income. I would even talk about maybe getting a little bit more earlier, just because it's going to save you, 1, probably more money now if you get it when you're young, and 2, your health, and especially if you're healthy, which most people are when you're young, it's going to, you don't have to worry about, let's just say in 10 years, you want to look at getting more, but you know what? Now you're pre-diabetic or you had some sort of heart issue, or you have, even if it's minor, health insurance underwriting is very stringent and they look at everything. They even, besides health, and I backtrack on the first question, they look at your motor vehicle. They run your motor vehicle. If you're gone into a lot of that, or they look at your criminal background. A lot of people have had some issues in the past. They look at these things. So these are other components of the underwriting process where people don't even realize that they're looking at these things, and they will look back at these things. Conventional wisdom, you read a book, it's going to say 8, 12, 15 times income. But I always say, let's look at a little bit more now, because $1 million 10, 15 years ago was, oh my God, it's great. My family, now $1 million, you have 2 or 3 kids and they have to go to college. You're the primary breadwinner in the family. It protects your wife from, not that she wouldn't have to go back to work, but should take her time, hopefully pays for help for college, and so forth and so on, a mortgage that you have. So there's a lot of components. Like I just say, if you're looking at just income, but look at your mortgage. Hey, there's some people who, making $100,000 that have $400,000, $500,000, $600,000 on the mortgage. You die, that mortgage is still owed. You're the primary breadwinner. Is $1 million going to put a dent in it? Yeah. But after you pay your mortgage off, or if you pay your mortgage off and you put the kids through college, what do you have left of that? So yeah, there's a lot of components to looking at so it's definitely subjective. It's definitely a case-by-case situation. If you're born into wealth, then you have estate planning issues, and who's going to pay the taxes if something were to happen to you if you died. And so you can use life insurance for that.
Yeah, man. The rabbit hole runs deep here. And I'm starting to see, I know I asked you in the last podcast we did, why you ended up getting into financial planning and also taking on life and health insurance.
Yeah, there you go.
It's starting to make sense now. It seems like really everything is so customized for each client, for their specific situation. And you're really like, you got to go in there with them and sit down and have conversations and really diagnose like where they're at now. What are their goals moving forward? It's like the clear picture of what their entire future is going to look like with their finances and their investments and their life insurance. So just even more, all the more reason to have somebody that you know, like, and trust, somebody that you feel confident with, that understands your situation and your personal goals moving forward.
Yeah. And that was to bring up to that point. Last time we talked about why I do the insurance and the financial plan, because I would sit in meetings and be like, it's a big component of your financial plan, the life insurance, absolutely, the health insurance. So yeah, I mean, it's very important. Most financial advisors do the life insurance end of it. I would hope so. Or they'll just say, talk to this person, you need this. But it's nice to sit with, I feel like, hey, you're sitting across from somebody who's also going to hopefully will manage your assets, but will also use the insurances because it's a big component of your financial plan.
Yeah, that brings me to the next question. You were talking about different types of life insurance. Specifically, I think that the two that are thrown around most are term life insurance and whole life insurance. And why don't you give like a brief synopsis of term versus whole.
Yep.
I have some experience in that in terms of whole life insurance, which I got some policies when I were younger. And those are also, that ties into the financial planning side. Those are powerful. From what I understand, my daughter has a whole life insurance policy that we started basically after she was born, and we paid into her for 10 years. And it's my understanding that if she just sits on that for the next 20 years, there's an awfully large amount of cash in there. And then you could do things like borrow against that money and pay for college through it. There's all sorts of tax benefits, like really powerful vehicles. So why don't you first start by talking about what term is and then bridge into whole?
Yep. All right. So this really, when you talk about whole life, you're talking about permanent life insurance, and there's a lot of different permanent life insurance, but really term is going to be your bread and butter. It's your cheapest form of life insurance. It's basically term because you get it for a period of time, a term. So it can be 10 years, 20 years, 30 years. 30 years is the most popular, especially when you're young. And what that means is if you get a 20 or 30-year term, you're going to have that as long as you pay the premiums, level premiums, meaning they stay the same every year. They're going to be the same every single year for 20 or 30 or 10 years, whatever that term is. It's the cheapest form of life insurance. And the reason for that is because you're essentially renting insurance. Okay. Just like you get a lease or it's just for a certain term. And it's typically, they can increase it, but really after you're done with that lease, you have to sign a new one, right? Yeah. You're done. Okay. With term insurance, after that term, whether it be 10, 20 or 30 years, once that term's up, you're done. And you have to reapply if you want more insurance. Okay. If you're 20, 25 years old and you get a 30-year term, it'll take you till 50, 55. Okay. And at that point, you have to decide if you want more. Now, there's certain features in these term policies where you can convert them to permanent, like a whole life or universal life. And we'll get into that quickly. But really, term is it's the cheapest form of insurance. You're getting it for that term. You're essentially renting insurance in the sense that after the term is up, you're done. Okay. And then you don't have it anymore. Okay. Unless there's certain features, like I said, but we won't get into that right now. So that's really when someone comes to me, especially a young couple, and say, hey, I say to them, you need life insurance. I'm going to start with term. Okay. Especially somebody we're talking about just basic insurance. Now, when you talk about whole life, it's a whole different animal. Yes, correct. There's a savings component to it. You can pull money out of these things over time. Okay. The thing about whole life or universal life or index universal life, these are permanent types of policies. So what does that mean? Basically, you did what's called, you mentioned your daughter, we paid into for 10 years. Okay. Yeah. They, you can figure out how you can pay into these things for life. You can pay into these things for a period of time. They're typically a lot more expensive than term because they are permanent types of insurance. What do I mean by that? Meaning that as long as you're paying the premium or the premium that you paid over that 10 years, which they calculate for you, the insurance companies, based on certain factors. Okay. Typically it's an interest rate on a whole life policy. As long as there's enough money in there to pay the cost of insurance, or you're paying the premiums for basically till age 60 or 65, that policy will last in theory for the rest of your life. You don't have to, it's not a term where after 20 or 30 years, it's done, or 10 years. With whole life, it's a permanent policy. They're 5 to 10 to 15 times more expensive than term. And the reason for that is because of that savings component in them, you build cash value in these policies.
Yeah.
Yep. The cash value build is separate from the death benefit. You can pull that cash value out. The cash value, depending on whether it's a whole life or index universal life or universal life policy, is the cash value builds based on an interest rate, or sometimes there's a market component to it. But they're typically a lot more expensive. Now, when you're talking permanent policies, this is not something I believe. This is my financial planning hat getting put on, that they should be bought for death benefit unless you're very wealthy and you have an estate planning issue. These things, in my opinion, okay, and it's really are bought for the investment aspect of it, for the savings component to it. And without getting too much, maybe we'll have another topic on a podcast about the ins and outs of permanent insurance. But really, you mentioned it. You can pull money out tax-free if done correctly. You're borrowing against the policy. It's a very powerful vehicle.
Yeah, the dividend pays back the loan.
So yes, the dividend doesn't pay back the loan. What happens is, let's just say the dividend adds to the cash value. So you have a whole life has a interest rate component to it, saying based on we're going to pay 5%. But the way most whole life policies work is you get what's called a participating policy. So you're, as a policyholder, you're actually an owner of the insurance company, and you get a dividend from the insurance company based on their profits, and it gets thrown off to you, a policyholder, because you're in theory a shareholder, and it helps grow that cash value. Now, and that's a great thing, but basically, you know, you're building that cash value based on a dividend. Okay, you're paying back the loan when you take a loan against a life insurance policy, a whole life or a permanent policy, a universal life. What you're doing is you're not pulling money from the cash value, although you can do that. There could be tax consequences to that. When you take a loan against a whole life policy, what you're doing is you're using your cash value as collateral for the loan. And when you die, your death benefit pays back that loan. Okay. And the reason why that's done is because when you pull money out of a policy as a loan, there's no tax consequences to it. Loans are not taxable. And that's why they have books written on permanent life insurance, how they're used they're such tax efficient vehicles.
It's fascinating, Jarrett.
Yeah. I
mean, there's a reason why the most wealthy people pay such little taxes.
Correct.
They take advantage. Correct. There's so many nuanced tax loopholes in the system, and they're able to,
take advantage of it. Yeah. A permanent policy is a tax shelter. And like you said, now there are certain rules. A wealthy person can't say, that's a great tax shelter. Why am I not doing this? A lot of them say, I want to put in $1 million and just buy $1 million, give me $100,000 worth of death benefit. That's not how it works. For the premium that you put in, there has to be a specific amount of death benefit. And that's a rule. It used to not be that way in the 70s. And then the IRS said, no. You can't put $1 million in the policy and just say, give me a $100,000 death benefit, because there's such tax benefits to it. It's literally a tax shelter. Now, it's still an unbelievable product. Look, you're not going to do 30% in a life insurance policy, but you will do 5, 7, 8, 9% with really no risk except for the fact that if you don't pay the premiums, the policy will lapse and you can lose some money. But the real risk, the fact that you can pull money out tax-free, okay, and still, by the way, pull out all this money over time and still have a death benefit, which is tax-free to your beneficiaries. When you run the numbers, and if you're patient, it's a long-term investment. It's a 10 to 15 to 20-year investment. But if you look at it compared to a 401k, or unless you Roth a 401k, and we'll get into that, you have to pay taxes on that. Okay, so when you pull $100,000 out of a 401k and you're paying 20, 30, 40%, who knows what tax you're going to be in 30 years, but we have a $32 trillion deficit. Taxes aren't going down, I'll tell you that. So, when you're pulling money out of a 401k, 100,000, you have to pay 20, 30%, you're netting 70, whereas opposed to where you're taking money out of a life insurance policy and you need 100, you're getting 100. Yeah. So there's something called a taxable equivalent yield. And really, when if you're only doing 5, 6, 7% of a life insurance policy, when you factor in the fact that you're getting a tax-free draw off that life insurance policy, it really equates to 7, 8, 9, 10%, as opposed to, you may have returned 7, 8, 9% in the markets in your 401k. You pull that money out, subtract 20% off that. They're at least minimum. That's worst. That's best case scenario. Who knows? So but Jeremy, the one thing about life insurance, especially permanent life insurance, it's not for everybody. Okay. They're typically sold to the wrong people. Okay. 85% of permanent policies lapse. That's a fact. Okay. And so they're not supposed to be sold to someone making 50, 60, 70 grand. They're putting $500 to $1,000 a month into a life insurance policy. They're for people who can afford it, and not only afford it, but afford it over a long period of time. Because once you make that commitment, it's a 10 to 15. Because the way life insurance policies works, permanent whole life, is the beginning 5 to 10 years, you're not going to see tremendous. It's like buying a house. You're going to be a little bit underwater in the first few years. And the reason for that is they take most of the fees out in the beginning of these policies. And also, you're not, unless you're front running a policy, which most people don't do, where you're putting a big chunk of change in the first 5, 2, 3, 4. Most people do it on a monthly basis, 500, 1,000, 15, whatever it is. So it takes time to build that up. Okay. Even if you're doing 5, 6, 7%, you throw in 10 grand into a policy and you do 5%, great. You're making $500, $600 on that year. You're not going to build these things in 2 years. I have 3 separate permanent policies. I also have a 401k. There's even people who write books and saying get rid of the 401k and just buy permanent policy. I don't necessarily agree with that, but it's a piece of the pie. Okay. It shouldn't be 50% of your pie. It should be 10 to 15, 20%. If it's, something that is right for you, but these policies are not for everybody. They shouldn't be sold to someone coming out of college making 50, 60 grand where you're putting, because most people who buy a permanent policy, who make that commitment, they can't say, oh, I have to put a new roof on my house, or I just need new AC. Forget that. I got to get rid of that policy. You should be something where it's part of your budget, where you're saying, you know what, I can commit to 500 or 1,000 a month, whatever it is. Okay. Because really it doesn't work unless you're putting that kind of money in there, even more sometimes. And you got to factor in the fact that in life, especially when you're married, you're going to have something that's going to cost you. You're going to have you need a new roof. You're going to need a new AC. So if you have something where it's going to cost you 5-10 grand, and that's going to limit you from making a premium payment, it's not for you.
It's not for you. Yeah.
It's not for you. So you got to be very careful when buying these type of, what you did for your daughter was great. She said, I have one for my kid too. I did it when he was a baby, and that's a different strategy.
That's when it's really powerful.
Yeah. And really,
obviously the sooner you start, the more effective.
Yeah. I'm not doing it because I'm scared that he's going to die for the death benefit. No. I'm doing that so one day I can say to him, now I'm the owner of the policy and he's the insured, and I have total control over it. And one day ideally I either can say, hey, you're getting married, let's pull money out of your life insurance. Well, you need money for college, aside from 529s and prepay and all that stuff. Hey, let's pull money. Or, hey, son, here's $100,000 policy that's built up for you, whatever the death benefit, but there's $100,000 in there. That's yours. I'm going to give you the ownership. I love you. Go live your life and leave me alone for the next 15 years.
Hey, I got a question for you. Am I correct in saying, tell me if I understand this properly. Maybe I don't. When you have a whole life insurance policy and you pay into it for the entire, however long it is, there is still a death benefit that you get at the end of your life through that policy. And you get the cash value along the way as well?
So in theory, yes. So really, if you structure these things correctly, the way it works is, let's just say in your daughter's policy, you built up, when she's 40, she has 150,000, 200,000 in there. Okay. And she's, you give it to her and now she has $200,000 cash value. Her death benefit is typically 2 to 3 times that amount. So you have the cash value, you have the death benefit. Let's just say she takes money out of there as a loan. And she takes 100,000 out of that 200,000, or 50,000 out of that 200,000. What happens is she pulls that money out. It's a loan. It's called a wash loan. So yes, there's embedded into these policies is a interest rate that she's going to have to pay on that loan. Now it's capped out typically at 5 or 6%. They're very beneficial loans. You're never going to, it's not like today where interest rates have gone up and so your mortgage is 7-8%, whereas they were 3% a year ago. There's a cap on the amount they can charge on the loan, but because it's a wash loan, because what they do is they say, okay, we're going to charge you 5% on this loan, but we're also going to credit your cash value 5%. Hence it's a wash loan. So you're crediting your cash value, even though we're charging you 5%. It's a wash loan. Now that 50,000, she can either pay it back, okay, over time. She can let that loan, it'll grow, even though the cash value is going to grow too. And when she dies, that death benefit, sometimes it's increasing, sometimes it's level. She's going to pay that loan back at death. Now, if she's taking a loan at a very young age, like I've taken a loan out of my policy just because, and I paid it back. I took out $15,000 out of one of my policies just because it made sense. I didn't feel like taking it out of my cash. It was invested. And I just put in $500 a month and I just paid it back. And now I don't have a loan on it. But you can, in theory, carry that loan for the term of, until she dies. That loan, that $50,000 loan, may be a little bit more when she gets older because of the interest rate. Now, granted, she's getting credited the money in the cash value, but they're separate entities. And then her death benefit of $500,000-$600,000 will be decreased by the amount of the loan. It gets paid back at death if she doesn't pay it back prior during the course of her life.
Yeah, man. All the more reason, the more we talk about this stuff, just all the more reason why you need a trusted professional like yourself to kind of guide you through all this, because it's overwhelming. And if you're not dealing with
they're complex, they're complex products, Jeremy. And also another thing is, which we talk about, life insurance, like your retirement accounts, cannot be attacked by creditors. So they're asset protected vehicles. Okay. And so a lot of doctors and lawyers, my brother is a surgeon. Okay. He has huge life insurance policies because he's a target. Now, there's other things you can do, putting your assets in, titling your assets certain ways and putting it into your wife's name. There's a lot of different strategies, trusts and irrevocable and revocable trusts. There's a lot of, but one of the things that doctors and lawyers buy a lot of are life insurance, because they can't be attacked by creditors. And so for them, there's a target on their back. Everybody wants to sue a doctor. So that's another component to it, which is a huge component for especially for doctors and lawyers and people with large assets. And so annuities, stuff like that. But yeah, they are complex products. They should not be sold to everybody. Typically, when I talk to somebody, also, by the way, permanent policies these days, whether it be whole life or universal life, are an excellent way. And we'll have another podcast on this, of buying long-term care. Yeah. Now, the big way of buying long-term care are being done via permanent policies through a hybrid policy where you can accelerate the death benefit to use for long-term care. That's another reason to buy it.
Yeah, a lot. There's certainly no shortage of topics surrounding what you do. So let's end it there.
Yep.
There's quite a few other questions that I wanted to get through. We could do that in another segment. But yeah, this has been really beneficial, Jarrett. And then for anyone out there that's listening that wants to learn more, that wants to start this conversation and wants to start protecting their family and really looking at how that whole picture plays out in their overall financial future, what's the best way to get a hold of you?
Yep. Like most people, have an email address and phone number. Email is Jarrett, JARRETT at Osborn, OSB as in boy, ORN, financial group, all one word, .com. Phone number 954-963-3300. You can check us out on our website, osborninsurance.com or osbornhealthinsurance.com or osbornfinancialgroup.com. Or go on our Facebook and Instagram at Osborn Insurance. You can just look us up. Last name is OSBORN. There's not many people spell it like that. Check us out. Feel free to give us a call, shoot us an email if you have any questions or would like to talk.
Good stuff. And we'll, of course, put a link in the description to all your contact information. And guys, if you have any thoughts, comments, concerns, if there's anything that was unclear, leave a comment and start a conversation, right? Get involved. This is how we learn, by sharing ideas, and just makes everything better for everybody all around. So,
yep.
Jarrett, always a wealth of knowledge, always a pleasure seeing you, brother. To our listeners, thank you so much for tuning in, and we look forward to catching you on the next episode of the Osborn Financial Group podcast. Everyone take care.
Thanks for joining us. Everybody. Appreciate it.
All right. Bye, guys.
Have a good day. Bye-bye.
Thanks for tuning in to the Osborn Financial Group podcast. For more financial tips and personal advice, visit us at www.osbornfinancial.com. That's www.osbornfinancial.com. Or give us a call at 954-963-3300. Take charge of your financial future today.